So we have credit risk and we have market risk. That you probably have heard of referred to as price risk or, investment risk. But specifically, market risk is the volatility of interest rates, foreign exchange, equities, and commodities. Okay? Specifically, I spend time on credit risk and market risk because those are the only two risks that you can hedge or speculate on with derivatives. Right? That's it. So if I have a liquidity risk, what do I mean by liquidity risk? There's two definitions for liquidity risk. One is simply I don't have the cash to meet my obligations. It doesn't mean that I'm going bankrupt. It just means right now my client hasn't paid me, for example, but he's going to pay me a week from now, but I owe you the money right now. That's one definition of liquidity risk. The other definition of liquidity risk is that I may not be able to buy or sell an interest rate product, an equity product, a commodity product, or a foreign exchange product when I want to and at a price that I want. And that's really a situation that a lot of companies and banks are in right now. They're holding a whole range of assets. They don't even know how to mark-to-market them. They don't know how to price them right now to see what their value is because nobody's giving them any quotes. There's no liquidity in many products. But there is no derivative to hedge for liquidity risk. You can do better planning, you can do liquidity planning, but there is no derivative in the market for this. What about operations risk? That's a huge risk that finally many financial institutions have started to pay attention to. What do I mean by operations risk? Anybody want to help out? What kind of an operations risk might a bank have or a corporation? Correct. Records aren't kept, so that would be things like we can divide operations risk into four areas. We'll start off with the first one, which is of course people. If I don't keep records correctly, or I make a mistake, or I'm fraudulent, or I commit insider trading, right? Or I show up to work all the time, but I'm surfing the internet, I'm still collecting a paycheck, but I'm not working, or I'm sick all the time, I don't mean to be absent, but you're counting on me to do the work. All those kinds of human resource things that often, unfortunately, are ignored are considered an operations risk under people. And this isn't just a definition I came up with. This is now a standard definition that is used by the BIS, the Bank for International Settlements, and finally, under many, many regulatory regimes around the world, financial institutions have to allocate capital based on the level of operations risk that they have. But so far, I've only talked about people. You have processes, right? We have a manual at my specific bank. I'm only supposed to trade certain products with certain people, but I decide to disobey that process and do something else. That's a people problem, but it also counts as a process problem. Okay? If you are a trader and you are transacting a product and you go over to the back office and tell the settlements people, oh, it's okay, I approve that trade, that's a huge breach in process. Right? So those are some examples of a process violation. You also have technical or technology. That's a third area. And that's quite a big catch-all, but it's also under operations risk. Things like power outages that may impede the business from functioning as it normally does. Software problems, hardware problems, anything like that is considered technology or a technical problem. And financial institutions grapple with how much capital to try to allocate for those kinds of problems. And finally, you have external threats, and that's an area that's been getting a lot of attention in the last couple of years. An external threat would be anything like terrorism, hacking, natural disasters. Right? People lose millions of dollars when any of these things happen. And all of these four areas, people, process, technology, and external threats, are part of the broader definition of operations risk. As you can imagine, that is one of the hardest areas for financial institutions and corporations to figure out how much capital should we allocate to try to predict, if any of these things happen, how much of a loss can we suffer. But there is no derivative to hedge for operations risk. You might improve and strengthen your processes. You might hire more lawyers. You might get better auditors. You might buy insurance for certain things, like against hurricanes or against fire. But there's no derivative for this instrument. We have legal risk, and legal risk can be subdivided into compliance issues, meaning there are certain rules that you're supposed to abide by and you don't. So that's a compliance problem. And then you also have documentation. You probably don't want to hear how many stories I hear around the world, including very much in the U.S., from bankers, hedge funds, and corporate treasuries, how much they still have problems with not getting confirmations on time, parts of confirmations where there's errors, confirmations that are missing, things like that. All of that is under legal risk. But there's no derivative for legal risk either. There's no swap, there's no credit derivative, nothing like that. And finally, you have strategic risk, which is sort of a broader area of when financial institutions or companies have defined their mission to be a specific area, and then they change it. Well, if they make a mistake, obviously that can cost them a lot in terms of reputation and also in terms of potential loss of business. But again, for that area, there is no derivative. So the derivatives that exist are you can only try to mitigate a risk or speculate on credit risk and market risk. That's it.